Hello, good morning, everyone. My name is Monica, and thank you everyone for taking the time to join our FX Pesa webinar. I'm sure that some of you are aware that initially we had planned to host a seminar instead in Nairobi Intercontinental Hotel. However, as you all know, with the spread of coronavirus, we really had no other alternative to change to a webinar platform instead. It would have been to meet you all face to face, but you know the main benefit of having a webinar is that you can all enjoy it from the comfort of your home, and you know you can wear it, you can listen in with pants or without pants. Our webinar today is split into 3 sessions, small 10 to 15 minutes breaks in between. So I do urge everyone to participate all the way through the webinar, as we also have a very special prizes to give out to 5 lucky attendees. Now, speaking of the coronavirus, I hope you're all staying safe. It really has been rather strange few weeks for the whole world and also in the global markets. We've seen volatility absolutely skyrocketing, stocks and indices breaking their circuit levels on daily basis. It's something we do not witness often. Now, taking into consideration the aspect that we will be spending more time at home, there really is no better opportunity for us to really learn the skill and knowledge about online trading. And even if you have been doing it for a while, it's definitely a good opportunity for you to brush up on your skills, which is also the reason for this webinar, what is about to start. So with no further ado, I would like to introduce you to our keynote speaker, Bernd Skorupinski. He's an expert trader, hedge fund manager, and also co-founder and online trading campus. So Bernd, without further ado, you can take it off from here.
Cool. Thank you, Monica, for the quick introduction. I hope everybody can hear me and everybody can see the screen. So let's get started right away. So hello, Kenya. A very warm welcome from my side to today's webinar on how to trade Forex like a market wizard. My name is, as Monica said, Bernd Skorupinski, hedge fund manager, multi-asset trader, and co-founder of Online Trading Campus. We are a licensed investment consultancy and official trading academy based in Dubai. So I will not waste time to speak about myself. If you want to know more about myself, why I'm entitled to talk to you today about trading, you can easily Google my name and you will find a lot of information about myself. I'm here for you today and I want to use the time as productive as possible and create a lot of value for you in the next, well, 2 to 3 hours, right? So we are going to have 3 sessions today. Each session will last roughly 30 to 40 minutes. And in between, we have 5 to 10 minute breaks. And at the end, I will answer some of your questions. So if you have questions, and I believe you will have questions at the end of the webinar, please note them down and ask them at the end of the webinar so we can have a clear structure and navigate smoothly through the content that I created for you today. Okay? Deal. Perfect. So let's get right into it. Let me start with a very critical question, okay? That we have to answer first. Who is making money in the financial market? Is it possible to achieve financial independence? And is it possible to consistently make money as a trader? Well, some of you, I believe, because everybody of you come from a different experience level, I assume that's why we have to start from the very beginning, from the scratch, right? Some of you might have never traded before. This might be your first webinar. Some of you have traded for a longer period of time or just started off trading and learning the skill how to trade. But I believe we can all agree to one thing. The reason why you are here is that you want to learn the skill how to trade. And if you were to trade already consistently profitable, there wouldn't be any reason for you to let me say it provocatively, waste your time and be here and listen to me, right? So we all want to learn how, and this is not, and by the way, this is not a big deal, right? Everybody, even myself, had to start from somewhere, right? So the question, is it possible to consistently make money as a trader? Some of you, as you just started off trading, you might have your doubts. And actually, to be frank, rightfully so, right? So, because if you look at the statistics, if you check the websites of brokers such as Oanda, you will find disclaimer like this one. 73.5% of retail investor accounts lose money when trading CFDs with this provider. So this is, guys, this is quite a statistic, right? More than 70% of retail investors are not making money. And I would assume during this specific time right now, during the crisis, during the upcoming recession, even if you might say during the upcoming depression, right, where we are heading to, where we might head to, I would assume this 70% goes even to maybe 80 or 90% during this specific time. So this more than 70% of retail investors are not making money, according to this broker. And now, and this by no means is not an extreme, right? Because 70% seems to be somewhat of a norm. Here you can see a screenshot from another major broker, Saxo. The disclaimer here reads, 72% of retail investor accounts lose money when trading CFDs with this provider. So you can see that some of your suspicions and doubts about trading and investing in the financial market, regardless whether we talk Forex, future stocks, are justified, right? However, these numbers, obviously, me as a trader, intrigue me, because I would like to dig a little bit deeper. And it's important to understand, guys, it's important to understand why so many people fail, right? We have to evaluate that, why so many people fail. And I want you to look at these numbers that we just talked about, the 70%. I would like you to look at these numbers from a different kind of angle. Let's think about the disclaimers we just saw for a second. We can agree that it seems like that roughly 70% of all retail investors are unprofitable, okay? But that also means that 30% of all retail investors are in fact profitable. So it's not, so what does this tell us? Common sense, right? So it is not impossible. It is not impossible to be consistently profitable. So what is now the difference, right? Now, what is now the difference between the 70% and the 30%? Is the vast majority losing money because they are not smart or capable enough? Well, I clearly have my doubts here, because we are now roughly almost 350, 370, 400, almost 400 people in that room. We are almost 400 people in that room, and I doubt that I'm the smartest person here in that room. I really doubt it. I'm pretty much convinced there are much more smarter people in this room than myself. So that's why I say no, right? It has nothing to do with being smart or not capable enough. I think 70% of people lose money because they simply lack the education, proper tools, and also the skill to be successful. Think about it in a different way. Before we continue, I want you to change your perspective. Rather than saying trading is dangerous, because obviously you could say that because 70% fail, I want you to think that trading can be dangerous if you don't know what you are doing. If you don't know what you're doing, but it can also be very rewarding, right? For the 30% that actually succeed in the financial market. So in other words, would you not also have a 70% chance of crashing a Ferrari or Lamborghini, any sports car, if you were driving this car without prior experience, license, or training. So can we agree that it is not really the car that's dangerous, but it's actually the driver who are steering, who are driving the car? So that trading is not really dangerous, but it's the unexperienced and uneducated trader that is actually managing the risk here. So I hope I have another eye-opening question for you. So do you feel that the financial market as a whole might be a little bit of an unequal playing field? Do you agree with me? Because when we think about it, when we really think about the financial market as a whole, who's making the most money out there? Is it actually the big banks and institutions like Citibank, Bank of America, Goldman Sachs, Bridgewater, BlackRock, UBS, Vanguard, or is it us, the, how I like to call it, the average Joe trader or the retail trader, right? It's clearly, if you differentiate between these two groups, bank and institutions and retail trader, the average Joe trader, if you have these two groups, you can clearly say, well, obvious, it's the banks and institutions, right? Now, what you're going to be surprised with is the fact what I call, or what we call, the beginner or the novice traders. They almost trade the complete opposite of how banks and institutions are actually doing this. And the one thing that we all have to realize about trading and investing, regardless of asset class, it's always a net sum zero game. So this is something I want you to note down, right? So if there's a teaching point until here is that trading, regardless of asset class, is always a net sum zero game. I will explain this in a minute what that means, right? So trading is a net sum zero game. So and that's why I also illustrate that poker table, and we use this as an analogy. So what does it mean? For every buy transaction, right? For every buy transaction, there has to be a sell transaction. And for every sell transaction, there has to be a buy transaction. So let's say that I wanted to go out. And I wanted to go out and buy euro US dollar, right? Let's stick to Forex for a second, to buy euro US dollar. So when I go out and buy euro US dollar, there has to be someone that's willing to sell me euro US dollars. Now, would you agree that I would never buy euro US dollar unless I had a pretty strong feeling that that currency pair was going to go up, right? We can agree to that, right? Okay, so let's say you bought euro US dollar. Would you be willing to sell me euro US dollar if you also had a very strong feeling that it's going to go up? Well, no, of course not, right? Usually, I would say, usually or always, if you are selling something, you think it's not going to move up, right? That's why you're selling something, because you think it's not going to move up. So could you actually have the expectation that it might be dropping? Could that be the case? Okay, so we have now a buyer and a seller. Could you have one party that thinks it's going up and the other party thinks it's going down? Because at the end of the day, right, zero-sum game, we can't both be right, right? We can't be right. We both can't be right. So if you and I just agree that it's the bank and institutions that make the majority of the money in this market, we never want to be buying the market when they are selling it, or selling it when they are buying it, right? Instead of what we want to be able to do is clearly identify exactly where the banks and institutions are buying and selling it, and to position ourselves along with them versus trade against them, right? Does this make proper sense to you? I think that's pretty straightforward. So, because let's come back to the poker table analogy. We are all sitting, right? That's why I made this analogy. We are all sitting on the same table. The biggest, most influential and powerful banks and institutions, hedge funds, money management firms, and you and me, the retail trader and average Joe trader. And the money has to come from somewhere, right? It's not growing on the trees. Unfortunately, money is not raining. So it's circulating on that table, on that playing field, however you want to call it. So, but it's a zero-sum game, meaning it goes from the novice traders who don't know how to play the game of, let me call it, Wall Street, to the professionals who know the rules of Wall Street. Does this make actually sense? I hope this should make a lot of sense, this analogy. So what are the decision-making tools? Now, let's be straightforward. Let's be just straightforward here, okay? So what are the decision-making tools you should not use? And provocatively speaking, if you use any of these tools, you very much likely belong to the 70% group of retail traders who lose money, right? That's not a big deal, guys. We all started somewhere, as I said, right? I mean, I myself, right, started at some point who just lost money and then realized it cannot continue the way it's going, so I have to change some things. So all of these things that I stated here, news, central bank announcements, economic reports, earning reports, indicators, RSI, Bollinger Bands, etc. You know it, right? Trading and investment tips, support and resistance, right? Or trading signals from self-proclaimed gurus, one of my favorite ones, right? We're gonna talk about this about these trading signals, right? We're gonna talk about this in the last session of today, okay? And even broker recommendation. All of these things that I stated here, right? All of that is based on perception, thoughts, and opinions. And decision making based on that is always subjective. So if you're subjective in your approach, and here's the thing, guys, here's the thing. If you're subjective in your approach, you might make money here and there, because at the end of the day, every single strategy in the world sometimes makes you money, but you want to make money consistently, not only sometimes here and there. You want to make money consistently over a long period of time, and therefore you have to change your decision making approach. So, and now this piece, guys, this piece is for all the conventional technical traders out there. Have you ever traded? Have you ever traded using support and resistance, MACD, moving average, stochastics, Bollinger Bands, RSI, you name it? Here's my question, okay? If all those indicators worked so well, and all these free tools, so to say, that you just Google and find, and you can buy for $5 on Amazon on a book, right? If all those indicators worked so well and you were making all the money you wanted, would you really take your precious free time to listen to me today? Of course not, right? So the reason, also another reason why all these tools don't work, is that they are lagging indicators. They are lagging indicators, meaning they require price and volume to happen first. So they require price and volume to happen first before they update, which means you will be getting late. You will be getting in late and out late every single time. So you will always be coming late to the party, right? You will always be coming late to the party, and this will have an impact on something that we talk about in the second session of today, which is called risk to reward ratio. So you will be always getting in late and getting out late every single time. So let me now make another analogy, right? Learning how to trade can be easily compared with learning how to drive. So how do I mean that? Let me explain. Have you heard the stereotypical phrase, trading is risky, especially trading with leverage in the Forex or futures market is super risky? Have you heard that statement before? Or do you even think that this statement is true? Well, I personally have a big problem with this description of risk, And one thing I have noticed is that some people don't really understand risk, and especially for everyone here in this room. Now we are really 400 attendees. I'm really happy we have so many attendees here today. To fully understand risk, this is what we're gonna do today, right? So you fully comprehend the word risk and understand the word risk. So whenever I find somebody, me personally, whenever I find somebody that says that, hey, trading is risky, I have a little bit, not only a little bit, but I'm just saying, I have a little bit of a problem with that. Okay, why? Because it's why? Because it's kind of like saying what we just discussed. You know what? If I gave my car keys to a 12-year-old, he got behind my car and crashed my car. That's like saying, you know what? Cars are risky. And it's kind of true. Cars can be risky, but really, is that really where the risk was? So it's not the car, right? It's not the car that carries all the risk. It's the driver. And it's the same thing here. Forex, futures, stocks, and even CFDs, they are just vehicles. They are investment vehicles. And yeah, I mean, you can say they do have some element of risk. You know, like a Ferrari, you could say it's riskier. A Ferrari or Lamborghini is riskier than a Ford Fiesta or a Toyota Yaris, right? But you know what? I can drive a Ferrari with 10 miles an hour just like a Ford Fiesta, right? So really, is that where the risk is at? So who manages the risk? Who controls the risk? It's always the driver. And if you don't know what you're doing and you're doing one of these and you're driving one of these vehicles, yes, man, that is risky. So the risk is in futures, forex, CFDs. That is why we have to approach trading and investing in the financial market like learning how to drive. So you exactly have to approach it the same way, like learning how to drive. In order to go out on the street and being allowed to drive, you require what? You require a driving license. So how does a driving license, guys? How does a driving license in trading look like? Your driving license, so to say, consists of mastering 3 key principles of trading: identify market turns in advance, increase probability, and proper risk management. We're going to talk about everything, right? No worries. So let me briefly explain these 3 core principles. Probability. What about probability? What does it mean for a trader? As a trader, everything, right? Everything I do is based upon probability of success. Nothing is 100% certain, never in life, right? Especially not in trading. So in most people's investment strategy or trading strategy, they have, like, maybe traders like who participate here, let me ask you directly, do you have a quantifiable way? Do you have a quantifiable way of measuring probability before getting into any trade or investment? Sure, you could argue there's always the possibility, but possibilities, guys, possibilities are really not quantifiable. Anything is possible. It's possible I could win the lottery tomorrow, but the question is that probable? I don't even play lottery, but that's my point, right? Is it, even if I played, is it probable? So as a trader, we need to determine our probability of success at all times before entering a position. So the next principle is identify market turns, right? So this goes hand in hand with increasing our probability of success. What we have established so far in order to be on the winning side in this, right, zero-sum game, trading is a zero-sum game, we have to trade with whom? We shouldn't trade with the 70%, we shouldn't trade with the 70% who lose money in that market. So we shouldn't trade, or we are not allowed to trade with the retail traders, with the average Joe trader. We have to trade with the big banks and institutions. So before we go out there and start placing orders like a maniac, right? we have to be really good at identifying where banks and institutions are very likely to buy and sell and place our orders along with them. So we at the end of the day, you could summarize this. To cut a long story short, we have to be skilled, right? We have to be skilled. And the third principle is risk, right? So please think about a form of risk management, guys. Think about a form of risk management. If you're familiar with trading just a little, most probably your first thought might have been what? Placing a stop loss, right? So the first form of risk management that might come to your mind is placing a stop loss. So let me continue quickly to drive this analogy home. Let me continue with the car analogy. Does an airbag, right? Every car nowadays has an airbag. Does an airbag keep you from getting in an accident? Does an airbag keep you from getting in an accident? Well, what does keep you from getting in an accident are things like don't text and drive, don't eat and drive, don't drive drunk, obey traffic laws, and the list goes on and on and on. Your airbag is just a catastrophic avoidance in case you get into an accident. Insurance is there to mitigate losses in case you have the accident. True risk management, ladies and gentlemen, true risk management as a trader is knowing things like when to be trading, what kind of assets to trade, and where to buy and sell. In other words, on how to time the market, right? So what is now the correct way? What is the correct way? You need a clear structured plan. You need a clear structured plan, something like a process flow. No external influences may be included, and it has to be multiple, and multiple back testing is also required. So you need like a list, you need a list-like instruction, a checklist. This allows the execution of a trade through the necessary controls and action in the correct order. So bottom line, your strategy, whatever you use, right? Whatever you use has to be process-based. Whatever you use, I don't care at this stage. We're just getting off, right? Whatever you use, I really don't care. But make sure it has to be process-based. Has to be like a black and white rule book to become, and this is now the key principle, to become objective. You cannot be subjective in your decision-making matrix. In your process, you have to become objective. And this only works if you're process-based. And by becoming then objective in your approach, you can build what? You can build consistency. And by building consistency, you can become a consistently profitable trader. So this is important, right? We are not here to make money once in a while, here and there, sometimes. We are here for the long run. We are here to make money consistently over a long period of time. And you can only make money over a long period of time and become consistent if you are objective in your approach. That's the essential teaching point on that particular slide. So now, guys, let's assume that's the second step of your driving license, so to say. So now that we passed our driving license, we can slowly learn how to drive the Ferrari, right? Because most people think they don't have enough money to trade, and it's because they don't understand leveraged asset classes, right? They don't understand leveraged asset classes. So people think they need a lot of money to trade actively for income. And here's why. The average return in a year in a market might be 10%, right? We're talking about the stock market here, right? In order to earn 50,000 US dollars in income, you would have to have 500,000 US dollars in your stock trading account at that rate. But now comes the beautiful part. But what if you were to use leverage? Forex, futures, and CFDs offer 50 times, 100 times, 500 times or more leverage, and you can start those accounts with as small as, I don't know, well, I would say $5,000 with futures, and even much less with Forex and CFDs, right? You need only a couple of hundred dollars to trade Forex and CFDs, right? That's where the beauty of leverage comes in. So it's the high leverage that allows you to get great results even with small amount of money. And most people well, where I'm coming from, most people are just trading stocks, which is the least leveraged asset class out there. But let's discuss and clarify leverage for a second. We have to talk about leverage also, of course, right? Because it's a question to you. Can I tow a car with my bare hands? Of course not, right? If I had a tow truck, could I now tow the same car? Sure. So the difference here, as we just said, is leverage. Using leverage means that I can amplify my efforts through outside means. In the market, we want to amplify our dollars using leveraged tools like CFD futures, CFD stocks, Forex, you name it. People use the lack of capital usually as an excuse to becoming a good trader. But leverage evens the playing field here. As a Forex trader, right? As a Forex trader with $1,000 in my account, I have the same purchasing power as someone that has $100 or even $500,000 in a stock cash account. So this is the power of leverage. But the main thing we hear about leverage, that I hear about leverage in general, in the general world, is that it's risky. But the risk in leverage, again, does not lie in the leveraged vehicles, rather in the uneducated trader, or using our analogy, in the driver, right? In the driver. So the next step here, last but not least, well, once we have our trading license, driving license, however you want to call it, we have to keep our driving license. What do I mean with that? Now let's assume we have acquired the skill of trading and investing, and we are trading consistently profitable. I'm now able to drive and steer the Ferrari safely. However, it is still a big difference whether I drive the Ferrari with 10 miles per hour, 100 miles per hour, or even full throttle 150 miles per hour, right? So in other words, it makes a huge difference psychologically. Now we also incorporate here the psychology of a trader. So it makes a huge difference psychologically whether I trade with $100 risk per trade, $1,000 risk per trade, $10,000 risk per trade, or even $100,000 risk per trade. It means it makes a huge difference psychologically. So this is what we establish in the milestone plan. Okay, but the milestone plan, we will talk about how to establish a milestone plan and what actually a milestone plan means. We're going to talk about in the third session of today. Okay, so we will slowly and safely and aligned to our personal financial requirements and circumstances scale up our trading business, right? This is where the milestone plan comes in handy, and we talk about this, and I hope you're gonna like this piece of the presentation a lot. This is one of my favorite pieces, and this helps me personally a lot to evolve my trading and to slowly scale up my business. We're gonna talk about this in the third session of today. Because like any other business in this world, and we talk about trading as a business, not as a hobby, right? Trading can never be a hobby because you put your hard-earned money at risk. So it's definitely a business. So like any other business in this world, you don't make $1 million overnight, right? But you steadily and safely grow your business. So this is basically you mentally getting used to higher numbers in terms of dollar amounts in the trading business and still be able to make rational and objective decisions trading high amounts of money. So as I said, in regard to milestone planning and how this exactly works, we will discuss this later more in depth. So guys, as I said, in this webinar now we have already more than 400 attendees here. Everybody has a different experience level, and I cannot start full throttle here, get into a chart and analyze for you guys oil, gold, euro, US dollar, or one of the indices, right? I don't want to overwhelm you, especially not the beginners here. So for all the beginners, I want to build a foundation first, and based on that foundation, later on, right, in upcoming webinars, whatever, we can slowly build, based on that solid foundation, we can build that house, so you to build that skill. But first, solid foundation, right? So everybody here is on the same page. This is very important, okay? So let's start building the foundation of being fully process-based, rule-based, and objective. So each element of any trade that you're going to take today and in the future, all elements are crucial and sets the foundation for black and white objective trading and investing strategy. What are the components or elements of the trade? What do you think differentiates a novice trade to a professional trade? Well, a professional trade always, ladies and gentlemen, always consists of the following three components. Entry, you open a new position in any market at a predefined price. Important to keep in mind, here is the word predefined, guys, predefined. You need to know your entry price in advance, right? Identifying market turns in advance. One of the three key pillars that we have to master, right? The foundation of our driving license that we just talked about. It has to be predefined. Your stop loss. You close your open position at a predefined loss. Important to keep in mind here again is the word predefined. You must know your closing price and potential loss in advance. Target price, right? You close your open position at a predefined profit. As already mentioned, guys, it is important to keep in mind also here the word predefined. Everything, every single element has to be predefined. You need to know your closing price and potential profit in advance. So now let's take a look at the fourth element. We just thought there are only three elements. No, there is a fourth element in place as well that only comes into the equation if all your three elements are predefined. And I call it, or we call it, forget. So why do we call it forget? Simply because if everything is planned in advance, predefined, you simply place a trade and you can, in quotation marks, forget about it. Also keep the word set in mind, as this acronym stands for stop entry target, okay? Set, stop entry target. Okay, so let's go through every element now, step by step. So we start with entry. We define it as the opening of a new position in any market at a predefined price. The main benefits of having a pre-planned, well-placed entry are numerous. Okay, so first of all, you have a higher profit potential as your entry will be placed as at the optimum price, or in other words, we never chase price. And this is what novice trader do, right? They chase price, but we talk about this also in a little bit. We wait for price to come to us. We buy what we call at wholesale, and we sell at retail. What this exactly means also we might discuss later. Secondly, as everything is pre-planned, we do not have to risk of becoming emotional and start chasing price randomly. And thirdly, get a life, right? If your entry order is pre-planned and therefore will be automatically triggered once your predefined price is reached. Your stop, okay, your stop loss. We define it as the closing of an open position in any market at a predefined loss. There are several reasons why placing a stop loss is mandatory, guys, right? Firstly, as with every successful business, you need to know, calculate, and to understand your monetary risk, your dollar amount risk. The amateur, the novice trader, the 70% that lose money in the financial market, right? First things about the reward. The professional business owner, right? As a trader, you are a business owner, ladies and gentlemen. Get used to that. You're an entrepreneur. Once you start out trading, you're an entrepreneur, you're a business owner, right? So the professional business owner first thinks about the cost of doing business and the potential loss of any investment decision. And secondly, as your loss is predetermined, right? Predefined, predetermined, you minimize the risk of becoming emotional in front of your computer and do something foolish that will result in a greater loss. And let's admit it here, guys, whoever has traded before, we have all done, right? We have all done foolish things, right? I hope you can admit it. I admit it in front of 430 people. We have all done foolish things in front of the computer when trading. If you have traded before, that's not a bad thing. But why? Think about why you did something foolish, because you got emotional, because you didn't have proper rules in place that gives you a clear process what to do in every single step of your trading strategy. So let me ask you an important question, and please take some time, really. Please take some time. I mean, I stated it already here, but please take some time to really think about this. Is getting stopped out okay? Is it okay to get stopped out? I mean, it's already stated on the slide, right? But that's also an important principle that I just would like to spend a few minutes on. Okay, so that's basically really an important question, because if you pursue a career as a professional trader, then you basically are a business owner. You're an entrepreneur, as I just said, similar to the guy down the street who just opened a coffee shop, right? Same thing, similar to the guy down the street who just opened a coffee shop. Regardless of how much money you're trading with, right? If you literally start off trading with $10, you are a small business owner. If you're trading with $10,000, you're a bigger business owner, right? It's just, the money doesn't mean anything. It's just, once you start trading, you decide to run your own business. That's how your mindset should go, right? So if you trade with small money, you're running a small business, and if you trade with big money, you're running a big business. And by running a business, regardless of size, you can consider yourself an entrepreneur. So this perception is important, because you need to ask yourself one thing: what does it take to be a successful entrepreneur? It is not about avoiding risks, because any business carries a certain risk. Rather, it is important taking calculated decisions based on an objective plan, a business plan. Why don't we compare the risks of the guy's coffee shop down the road, let's call it physical business, with your risks and online trading entrepreneur, right? So let's start with the coffee shop. The coffee shop and most physical businesses you cannot run alone. You must hire employees, pay salaries. On top, you probably have to pay rent. You need a coffee machine, a coffee bean grinder, a dishwasher, a lot of more utility costs. You probably have development costs, because a good barista needs training of your own products, right? So bottom line, I think we can agree that the guy down the street has a lot of costs, and there is a minimum amount of coffee he has to sell just to cover these on a monthly basis. So how much money does the coffee shop guy have at stake? In other words, what is his risk? Actually, his risk would include his initial investment, all of the aforementioned costs and monthly running costs of keeping the business going. Opening a physical business requires a lot of capital, and all of your capital is at risk. In trading, though, in trading, I would argue, if you do it professionally, it's much less risky than any other business. And I tell you why. You don't need to pay rent. You don't need employees. All you need is you. If you open up a coffee shop, you don't just go out and do it. No, you need a plan. Look at several locations. What's the footfall? How many coffees could you sell on a daily basis, and so on. In trading, you will also learn. In trading, you also will learn or have to learn to take calculated risk, to take a calculated risk approach. You will always and very dynamically be able to determine exactly the amount of money you want to risk on a trade. So if you want to risk $1,000 on a specific trade, the maximum you can lose is $1,000 if you do it professionally. If you say the maximum you're willing to lose is $5,000, then this is the maximum you can lose. And on the other side of the risk spectrum, let us say if you want to risk only $10 because you just started off with your trading career, then the maximum you can lose on this specific trade is $10. Bottom line, going forward, okay, going forward, you have to learn how to take calculated risks based on clear objective rules. So this is guys, I cannot emphasize this strongly enough. This is a very important piece of the puzzle. So now to answer the ultimate question, as I said, it's already stated on the slide, right? Yes, it is okay to get stopped out on the trade, because bottom line, because losing trades will be, and this is how you have to see it as a trading entrepreneur, right? It's not a loss per se, because losing trades will become your cost of doing business. These are your expenses. And by the way, your only expenses, right? And as long as your reward, your profits at the end of the month, at the end of the quarter, at the end of the year exceed your losses, your risk, you run a profitable business. Okay, that's how you have to see it. That's where your mindset has to be. When we talk about target, we define it as the closing of an open position in any market at a predefined profit. There are good reasons why placing a target is mandatory, guys. Firstly, you keep your emotions again under control. You don't get greedy and end up with a loss instead of a nice profit. This way, you already know what your profit or reward will be. This allows you to compare the risk you're willing to take with the reward you're prepared to gain. So, and this is what we call, guys, very important, this is what we call risk to reward ratio. We will now spend the second session, almost the entire second session. We will discuss a few more things in the second session that are related to risk to reward ratio, but we will spend the next session talking about this ratio, as it is, guys, the most important KPI, what we call key performance indicator. So short KPI, key performance indicator, key performance indicator. Okay, so there's also, of course, the possibility, you might know it, of having multiple targets as a mean of trade management. In other words, minimizing your risk and taking multiple profits once price goes in your favor, right? So to sum it up, the elements stop and target close an open position. If the stop is triggered, the trade will be automatically closed for a predefined loss, and on the other side, target for predefined profit. I simply, ladies and gentlemen, cannot stress this enough. Exits always must be pre-planned. If you're trading already and your exits are not pre-planned, stop or target, stop trading right away and learn how to pre-plan it, because this will end, believe me or not, this will end very badly for you. So in general, if your exits always are pre-planned, this will help you tremendously. This will help you tremendously with managing your emotions and your risk. And just in case you were wondering, exits are not placed randomly, right? Rather, they are calculated and objective positions placed as per your rules, based on your strategy. This is the only way how our entire decision-making process can be audited in favor to become consistently profitable. So you're set, right? Stop, entry, target. You're set, and forget, set and forget and get alive, right? Set and forget and get alive. This is what we call it. What we call it here, set and forget and get alive, is not just a strategy, but it's also a lifestyle, right? So this has to become, guys, for every trader, this and investor, this has to become an important pillar for your trading business success, right? So now, lastly, to slowly come to an end of the first session, let's talk about the forget approach. By placing a trade in advance, applying the predefined set parameters, stop, entry, target, you don't need to sit in front of your computer. How cool is that, right? It's actually the biggest benefit of trading. You don't have to sit in front of the computer 24/7 watching the charts all day long. You can actually forget, always take this, put this in quotation marks, right? You don't literally forget, but I hope you understand what I mean. Forget about it and spend some time on other things you are passionate about. We don't want, and this is what people get completely wrong when they think about trading and investing. We don't want to replace one 9-to-5 job with another, right? I firmly believe in the slogan, being rich is having money, but being wealthy is having time. Okay, so as you're not watching the charts all day long, what are the benefits here? You keep your emotions under control, and your predefined decisions are based on your trade plan. Your decisions are rational. Trade plan, what is a trade plan? Do you have a trade plan? Most people don't. We will talk also about what has to be the importance of a trade plan, and what you have to incorporate in a trade plan, how this should be structured, in the third session of today. So optimizing this approach is important for the long-term success of any trader and investor. I understand, guys. I really do understand that everyone here in this room who wants to acquire this skill set has other commitments, right? You guys have a full-time job, you have family, you have children, you have friends, and other hobbies, social commitments, right? Therefore, you have to use the time on and off of your computer, of your trade station, as efficient as possible. Me, for example, right? I only spend roughly 3 hours per week for my analysis, and that's it. Set and forget and get alive. So to conclude, right? To conclude, and this is the last bit for the first session. I think we roughly talked already almost 40-50 minutes, right? The time is flying crazy. So to conclude, trading is not only about analyzing charts. Trading is also about the so-called mental game, mastering your emotions and psychology. And that's why the concept of set and forget and get alive is so important and is essential for your trading journey. All the set parameters, stop, entry, target, are predefined in order to manage risk and your emotions. The aim is to eliminate emotional trade behavior such as greed and fear, and make your trading purely objective to become what? To become consistently profitable, because that's the definition of a professional trader and investor. Everybody states on social media they are traders. We talk about this. I'm gonna have my I'm gonna have my 10 minutes, 5 minutes rant about all these social media traders in the last session of today. So you'll hear my opinion about the people, about everyone on social media who states they are trader, because they're actually not. How can they, if we already know that more than 70% of the people in the market lose? How can everybody on social media be a professional, successful trader? That's just BS, if you ask me, and sorry for my language. But we talk about this also in the third session of today, because that's exactly the definition. When you ask somebody, right, that's the definition of a professional trader and investor. Someone who makes money not sometimes in the market, someone who makes money in the market consistently. That's the key takeaway, guys, for the first session of today. Someone who makes money in the market consistently over a long period of time. That's the true definition of a trader and investor, ladies and gentlemen. That's the end. That's how I want to end the first session of today. So now we have, I think now we have a 10-minute break. Monica
Yes,
will
that's
take
right.
over, and then we continue after 10 minutes.
Yes, Bernd, thank you so much for that. It was super informative. I really enjoyed that. So, yeah, as Bernd mentioned, we'll be taking now a short break, so you can all go and grab a snack quickly, and at the same time soak in all this super good information. Also, just to let you know, guys, if you have any questions, please go ahead and type them in the chat box. We will be answering all these questions at the end of the webinar. So yes, let's take 10 minutes, and then we'll return with the second part of the session.